Troy, I want to reflect on the data we've had so far this week, going into a week full of economic data, really concluding with payrolls on Friday morning. Would you see that data, that strength, as a good thing or a bad thing for risk assets?
Well, for risk assets, it still continues to be a good thing over the medium term in that stronger economic growth leads to more revenue, leads to lower default rates and credit. We're getting to that inflection point, though, where you had a violent enough curve move yesterday that equity markets finally paid attention, right? If you think of Q1, you had another quarter where fixed income was down, like a broken record, like we joke around about. But equities were able to power ahead because not only did you have very strong earnings, but obviously the economic growth surprises were relatively robust. And Powell started to jawbone about, some would say, premature cuts. So, we're at a more dangerous level in terms of valuations. But generally, that rebound in manufacturing should be looked at as a positive outcome and a positive driver.
Troy, you say the equity market started to wake up. I mean, I've got to question that. We were down 0.2% yesterday on the S&P. We're down 0.2% this morning. I think the equity market's still snoozing, isn't it?
Yeah, well, compared to previous higher rate-driven dislocations, I mean, the most recent one, of course, was August to October of last year, where you got a material curve move. And 0.2% is kind of a rounding error. But, at 21 times forward earnings, you just have to ask yourself, how much more upside do you have when so much of the good news is priced in? And to the points you've been making already, there's a material risk of substantially higher rates at the back end of the curve. We still are fairly inverted. The curve has obviously been gradually pricing out cuts this year. But bottom line is, to Lisa's point, in the scenario where there are no cuts, you have to think the back end of the curve is going higher, and we could retest the 5% level at some point, given the substantial supply that's coming on, and obviously a technical picture that's not terribly supportive.
Does 5% this year?
We have thought, and we still think that's definitely possible. I mean, look, the way, when you think of the forward reaction function for the Fed, right, we've always said that this cutting cycle is going to be the mirror image of the 15 to 18, or sorry, this hiking cycle is going to be the mirror image of the 15 to 18 cutting cycle. Very slow and steady. And there's a reasonable probability that as the Fed first starts to cut, the back end sells off as inflation expectations get anchored higher. In the event that they don't cut at all and they continue to pursue QT, which they still are, as you know, there's certainly a risk that we make higher highs this cycle. And that's one of the risks that markets have priced out, we think, far too fast, particularly late last year and early this year. So, yeah, it's not that fixed income is tragic like it was in 2020, early 21. Or late 21 as well. It's just that the risk reward still isn't fantastic like many people have been articulating it is.